Hi, I'm Ishreth Hassen, one of the multi-counselor portfolio managers of the Global Equity Fund with a fund update for the second quarter of 2022. The Global Equity Fund outperformed in another volatile quarter, falling 11.4% versus the MSCI All-Country World benchmark, which fell 15.5%. Global markets fell steadily through the quarter, driven by high and persistent inflation, worsening consumer sentiment, and investors oscillating between fear of global central banks being unable or unwilling to remain hawkish long enough to quell inflation, and fear that rising interest rates tip the global economy into a sharp recession. Whether due to Russia's ongoing invasion of Ukraine, which has and will continue to crimp global energy and grain supplies, or due to China's continued lockdown, it's evident that supply chain issues are unlikely to be resolved in the near term, creating economic forces that provide both tailwinds and headwinds to some of our portfolio exposures. Last quarter, I spoke of how the outperformance in Q1 was not helped by our considerable Chinese tech exposure. We've spoken extensively about how much value is inherent in these names, and this quarter, we've started to see some of this latent value unlocked as Chinese regulatory pressures start to abate despite a still weak macro backdrop. The China tech complex as a whole was the biggest performance contributor during the quarter, with all names rising considerably versus an IT sector that fell almost 22% during the quarter. We have highlighted the valuation gap between these names extensively in the past, and it's pleasing to finally see the gap starting to close. Weighing on fund performance were the portfolio's commodity-linked equities, which gave up some of their Q1 gains that was catalyzed by the war in Europe. These businesses spanning copper, precious metals, and agricultural commodities continue to provide investors with great hedges against inflation and war and remain excellent diversifiers within the portfolio. The current sell-off is also enabling many new opportunities that we are very excited about. There are many high-quality businesses that we've tracked over the years that were simply too expensive to own in the past. Today, they're far more reasonably priced, and we continue to be vigilant in dynamically evolving our portfolio construction to be the best it can be for the long term.